fractional reserve banking. With life insurance companies, they are practicing something different. They must hold dollar for dollar reserves by law. They are state regulated, and there's also the State Guarantee Association that can step in if a carrier fails, which is really rare, extremely rare. Like back in 2008, 2009, Jeremy, there's 364 banks that failed. Guess how many large mutually owned dividend paying companies failed?
One of the most common questions we get, Jason, is my money protected in an insurance policy in the same way that it's protected by FDIC and a traditional bank account? So in today's episode, I kind of want to go over a little bit about the misconceptions and ideas behind what is protection and how traditional bank accounts work and the differences between a traditional bank account and your personal banking system. So with that, how's it been? How you doing?
I'm doing incredible. You know what I'm really conscious of immediately? It's a little silly, but the FDIC, they have a sticker, and their sticker goes on the bank. People like stickers, Jeremy. We like logos, right? So I just thought of that. Like if you got your FDIC sticker of $250,000, let's really explore and dive into what does that mean? Because like you said, is my money protected? Very common question. Is my money protected in one of these infinite banking policies, in one of these specially engineered whole life policies, the same way that that sticker protects it at the bank?
Yeah. So I think a lot of the FDIC discussion is really reactive in nature as well. You know, you mentioned you're capped at $250,000. And for a lot of people, $250,000 is a lot of money. But I had a brother-in-law who was affected by the Silicon Valley Bank shutdown. Remember Silicon Valley Bank from 2023? Well,
I do.
So their business had over 250K. So the FDIC capped it at 250,000. And if you're a business owner, you might be running into a couple issues with the $250,000 cap.
And that they're right there. Like, so if you walk away with nothing else, and as always, with everything that Jeremy and we're going to give you a bunch of nuggets today. We're going to show you a bunch of things, but we both want you making notes, not taking them, making them, meaning what is your action step? So if you are a business owner, like your brother-in-law, Jeremy, and you have over $250,000 in a bank account, start splitting it between multiple banks. If you're going to keep going in that direction, maybe by the end of this, you'll go in a completely different direction. But remember in 2023 alone, Jeremy, Silicon Valley Bank, over $200 billion failure.
Wow.
Then within, and this is all between March and May of 2023. So just listen to the numbers. That was with a B, 200 billion. And then do you remember First Republic Bank? $232 billion. And then the Signature Bank, $110 billion. Just do the quick math. That is over $500 billion gone within a few months.
Yeah. And not only is it quote unquote gone, right? But what actually happens when a bank fails? Not only is the FDIC reacting to a bank failure, so it's a reactive in nature. That coverage often relies on bailouts and printing more money. Yeah. So when the FDIC says, hey, we're covering your $250,000, how are they actually doing it? Well, they're actually devaluing your money by printing more money. That's what's happening. They're creating inflation.
And we looked this up, like you and I were doing some research prior to this because we wanted to bring you guys the best information. Like our listeners deserve the best. And we wanted to know, okay, well, what really happens? Well, like in the Signature Bank example, they just opened a different Signature Bank and they just transferred all the deposits, all the things into a new banking system. With Silicon Valley Bank, they did a similar thing, but all the funds, like you said, are being created or transferred in from other banking systems, right? And this whole Federal Reserve, federal banking system, the money is just flowing to bail out these banks. And that's how you're getting that reactive measure that you just mentioned.
Yeah. So how is a mutual insurance carrier different from a traditional bank?
That is the multi-million-dollar or billion-dollar question. It's because the whole life mutually owned dividend paying companies that we all work with to help with these policies, they practice something different, right? What we're talking about with banking, we might dive into this a little bit more, is fractional reserve banking. With life insurance companies, they are practicing something different. They must hold dollar for dollar reserves by law. right? They are state regulated. It enforces that solvency and surplus requirements. And there's also the State Guarantee Association that can step in if a carrier fails, which is really rare, extremely rare. Like back in 2008, 2009, Jeremy, there's 364 banks that failed. Guess how many large mutually owned dividend paying companies failed?
Pick me. Zero.
Pick it. Yes. Yes.
Zero.
You're not the best with these open quizzes that you weren't expecting, but you nailed that one, brother.
Yeah. Well, the mutual carriers have been around for hundreds of years, right? Like there's a reason that we like to bank with the carriers, with the mutual carriers, because it's part of becoming your own banker. It's that control, that solvency that we talk about. There's a word, sovereignty. I think that's a word that we use to describe this, right? The ownership of what it is that we're doing. We're taking back that control. And, I want to go a little bit deeper. What did you mean when you said the state regulated? Like if in the happen chance that an insurance or a mutual carrier did go under, what did you mean by state regulators stepping in? Like talk a little bit about that.
That's a great question. So the banks are all regulated federally. Like the FDIC is a federal entity. All of the mutually owned companies are run by state statute, and they're enforced. Like I said, they're enforced to have that solvency requirement to cover everything they guarantee. Right? And what are they guaranteeing, Jeremy? They're guaranteeing the death benefit. They're guaranteeing they have to have that money liquid. And so if something happens, then that guarantee association is going to step in and make sure that all of those policy holders get taken care of, right? It is not a reactive measure. It's already proactively, like we're talking about reactive versus proactive. We're talking builders versus borrowers, right? The way that this is set up, it is state statute because they don't want the federal government involved, frankly.
Mm-hmm. Yeah, absolutely. The fact that you have other carriers that are going to make sure that your banking system still stays in place. Remember, these contracts, that's really what they are at the end of the day, can be transferred over to another insurance carrier. So your agreement is still in force, right? And
Yes.
That's truly what your banking system is. It's a contract between you, private citizen, and the insurance carrier, the private company. And we like that privacy. We don't want the regulation that is involved with traditional banks.
No, and that's where you come back. Like, as soon as you said that, the first word that rang out in my brain and probably all of our listeners' brains was sovereign. That is sovereignty. That is the privatized nature of this banking system. So rather than having all your information public knowledge, whether, it comes like, you think about the big wealth killers, Jeremy, you think about taxes, you think about inflation, you think about attorneys, especially if you're an entrepreneur. Mm-hmm. And so when you're talking about this privatized system, I know we're really focused on the FDIC's illusion of safety today, and really talking about what it looks like when something's been established and profitable every year for well over 100+ years. And think about some of the things, Jeremy. Name some of the things that have happened in that last century where this strong mutually owned companies have remained profitable no matter what.
Yeah, if we go forward or backward. If we go backward, COVID.
Oh, that sounds fun.
All right. So we had COVID. We had the war on terror. We had stock market crash, dot-com bubble. We had, dude, it just goes on and on. We had 9/11. We had Vietnam, World War II, World War I.
Coming off the gold standard.
Yeah.
We had the inflation of the early 80s, right? We had all kinds of crazy things.
It seems like every decade something bad happens, right? And I know that there's a lot of, is it by design or not? It doesn't matter if you already control the banking system, whether it's by design or not. Because if you have the full control of your banking system, you're exempt from judgments, liens, bankruptcies. You're not being subjected to rules, laws, and regulations set by other people. You're actually sovereign. You have the sovereignty to control the banking system. It doesn't matter if there's a stock market crash, a housing bubble, a crypto crash, if there's a war, if there's a pandemic, you control the banking function. Your money is in your control.
And it's guaranteed.
Yeah, I like about that.
Yeah, we kind of like control and guarantees. I don't know what that says about us as men, as leaders, of our family, of what we're putting out into the world. but we like that sovereignty. We like that control. If you like that, then this is a conversation we want you involved in. We want you learning and practicing what we're teaching. You might think that sounds kind of big, right? But let's look at why the life insurance companies are structurally safer, Jeremy. You know, how is the mutually owned, dividend paying whole life companies different than a bank? Let's go a little deeper into, I know we already talked about the dollar for dollar, but let's talk about what they're practicing in comparison to fractional reserve lending. Let's kind of dive into that a little bit more.
Yeah, so you kind of hit on it a little bit ago. The dollar for dollar reserves, right, for everything that's guaranteed inside of the policy. The fact that they have their buddies at the state level that can come in and bail out, even though they haven't needed to. Like for the last 100 years, wars, recessions, pandemics, no major mutual carrier has ever fallen, not one. But you put your money in all these other banks and you do what the normal people do and what everyone tells you to do with your money, and you're open up to volatility.
Yep. You open up to volatility. You got to start playing that game where, like, your brother-in-law, like if he would have had this conversation with us, if he was going to keep that much money in a bank, he may have, put the money in this bank and some of it in this other bank and some of this other bank. And that way he's kind of moving the money thinking, well, all these banks can't fail at once. But we've seen it before that is not necessarily true. And then what I was looking for there was more of the insurance companies only betting on one thing. How long will Jason pay their premium deposits? Because they are able to know how long you and I are going to be here, brother, till we shuffle off. And anybody who's listening, if you have a policy, it's the same thing. That is why they're so solvent. Mm-hmm. Because they are also thinking long term. Their investments are long term. When we look at their portfolios, they are slowly growing at, 8%, 9% year over year. And when I talk to some of the chief investment officers from some of these giant mutually owned companies, they're like, hey, we have a plan for the next 150 years. I didn't understand anything else he was telling me about all the investments, all the cool stuff they're doing. But just knowing, like, we think for ourselves and, we're not borrowing our thinking, and we're set up for generations to come because we have to deliver the one thing that's most important, and that's the death benefit.
Every single contract that they have is 121 years. So they already, like you're saying, they're thinking generationally, they're thinking multi-generationally. So every new agreement, every contract they sign with a new person is 121 years. I mean, so yes, they have to plan for over a century on how to return that premium, how to return that death benefit, the true legacy value, the tax-free legacy value to those beneficiaries.
Yeah, that's such a strong point of just talking about that. And these companies have been around longer than what we're talking about. And guess what, Jeremy? This wasn't part of what we were going to talk about today. But how can we talk about the difference between the sticker that the FDIC and where are these banks that have been failing? Jeremy, where are they putting the majority of their money?
Bank-owned life insurance, BOLI.
Yeah, that's not the topic. We have a whole nother episode on that. But geez, like, if they are the number one purchaser of this stuff and they're not keeping their money in their own system, what the heck is that telling us? Like, how do we not even put that in our show notes as part of this? Like, that's pretty wild.
Yeah, they are having, I think, is it Bank of America that has $24 billion in bank-owned life insurance?
Yes, it's got to be more by now, right? Last time I found an accurate statistic that I could find, it was in the end of or quarter 3 of 2022, and it was $225 billion total between all the banks. And They have 4x the number of whole life insurance that they've bought since 2012.
Yeah. We actually did a really deep dive on bank-owned life insurance. That was episode 7.
Well, thank you for finding that quickly. I can never find our guide, so you finding it that quickly for the members, you guys don't know how impressive that just was. So
episode 7, we went into a deep dive and how banks secure themselves using properly engineered whole life insurance.
And as always, like, our bottom line for everyone listening is that IBC, the protection is real. They're thinking future forward. They are being proactive versus reactive. They have audited capital, not government promises, not a sticker on a window. And so, Jeremy, like, what do you think if we're listening to what we're saying and our listeners are listening to what we're saying? What do you think the members' takeaway should be for all of this?
The number one thing is that your money is backed by dollar for dollar reserves, right? It's not going to disappear with a crash. It's not going to disappear in a bank run, right? Like we saw with Silicon Valley Bank. It's built for long-term promises, not short-term speculation. Think about that. Your personal banking system is built for long-term promises, for guarantees. There's no speculation here. So when a member asks whether or not their money is safe, the answer is simply yes. It's protected by structure, history, and the law.
And I felt like I was going to get like the shivers, like, ooh, say it again. It was like Mufasa. Mufasa, say it again. A little bit with, hey, it is built for long-term promises, not short-term speculation. You don't have banks creating additional banks to bail out the banks by printing the money for the bank that just failed because they practice a system that they only keep 10% of your money, Jeremy. And so the bottom line, what we're really talking about again, is it's like you said, protected history, structure, law. It is something that goes well beyond any of the systems that are in place where people are really putting their money. We want you to have control. We want you to have sovereignty. So that's the takeaways for all of you, is really the mind shift that the banks and insurance companies aren't playing the same game.
Not even close. Not even close are they playing the same game.
Not even close. One is printing money whenever they need money. It's causing inflation. It makes, it very difficult to go to the grocery store and buy good food, right? Because the money is not worth anything. And if you're confused by that, think about going and buying your favorite candy bar 20 years ago. I could go get a Snickers bar and get two of them for $1. Now they're overpriced, oversized, trying to kill me, and I can't even get a candy bar for that much. And I'm kind of wanting a candy bar right now. But when we were looking at this, like you said, it's backed dollar for dollar. It's called Austrian economics. If you ever want to dive deeper into that, we're here to have that conversation with you. Is my money protected? Yes. Am I trusting the right system to protect it? I don't know. The question for you is, where is your money being held?
Yeah. And if you don't want to do the research and you just want to have the conversation, again, go to wealthwisebanking.com. On that website, you can learn more about what it is that Jason and I are talking about today. You can reference a previous show, like I said, episode 7, where we discuss bank-owned life insurance and how they create guarantees and protection to prevent bank runs, and just book a call with us, right? Nothing costs you your time, right? At the end of the day, you might actually learn something new.
And Jeremy, thank you for sharing that. And as everyone listening, as always, we are so blessed to share what we're passionate about. And you giving us your most valuable asset, your time, so you can understand what they are doing, what the wealthy are doing with their money, so you can do the same thing. So to be a blessing to someone else, go share this episode with them. Go share this episode with someone who believes that sticker, that FDI sticker, is still the gold standard. Because why? They need to hear the truth. So Jeremy, you know what's coming next, brother. You're already in banking.
You're just not the banker yet.
All right, everyone. Be blessed. Until next time.
Take care.
Thanks for joining us on WealthWise Banking. If today's episode inspired you, please subscribe, leave a review, and give us a like. It's a simple way to help others discover these empowering strategies and join our community. Together, we're building a network of people who believe financial freedom is within everyone's reach. Remember, financial independence is about making every dollar work for you, one step at a time. Until next time, stay inspired, stay in control, and keep building your legacy the wise way.